The year 2007 marked a pivotal moment in modern economic history, as the housing bubble that had been inflating for years in the United States finally burst, sending shockwaves throughout the global financial system. The subprime mortgage crisis, a term that has since become synonymous with economic turmoil, not only laid bare the vulnerabilities within the housing market but also exposed the intricate web of financial instruments and institutions that underpinned the global economy.
In the early 2000s, the Fed lowered interest rates to stimulate economic growth. This causes rapid increases in housing prices fueled by high demand, low interest rates, and speculative buying. In the mid-2000s, lenders relaxed standards, offering subprime mortgages to borrowers with lower creditworthiness, thus increasing the demand and causing home prices to soar. In 2006-2007, rise in mortgage defaults, many homeowners faced difficulties meeting mortgage payments. Subprime borrowers experienced a surge in mortgage defaults and foreclosures. In 2007, the housing bubble burst, leading to a decline in home values, and declining home equity contributed to more mortgage defaults. In 2008, Lehman Brothers, a major investment bank, declared bankruptcy. The U.S. government intervened with the Troubled Asset Relief Program, TARP, to stabilize financial institutions. 2009 The crisis led to a severe credit freeze, impacting businesses and consumers. Global economies entered a deep recession, marked by rising unemployment and declining economic growth.
The 2008 financial crisis stands as a watershed moment in global economic history, revealing the interconnectedness of financial market and the profound impact of risky lending practice and financial engineering on the world economy. One of the primary drivers of the 2008 financial crisis was the prevalence of risky lending practice. Subprime loans extended to homebuyers with poor credit history became common. These loans, often characterized by adjustable interest rate, initially assisted borrowers with low introductory rates, but later subjected them to substantial increases. Additionally, predatory lending practice further worsened the crisis as lenders concealed hidden fees and imposed exorbitant interest rates, ensnaring unsuspecting borrowers in financial precarious situations. Other contributing factors was the securitization and financial engineering that characterized the era. Financial institutions bundled subprime mortgage into complex instruments such as mortgage-backed securities (MBS), where the risk associated with these securities was frequently underestimated, leading to widespread distribution among global investors. Credit default swaps (CDS) were employed to hedge against MBS default risk, but their proliferation added a layer of complexity and opacity to the financial system, ultimately contributing to the crisis. The effect of this risky practice manifested in housing market collapse. As subprime borrowers struggle to meet payment obligations, foreclosures surge in undating the market with excess housing supply. The ensuing decline in home value triggered a negative wealth effect, eroding household wealth and dampening consumer confidence. Many homeowners found themselves in a precarious financial position, owing more on their mortgage than their home were worth, amplifying the severity of the housing market downturn. Beyond the housing sector, the crisis morphed into a full-blown global financial catastrophe. Major banks and financial institutions faced substantial losses due to the devaluation of mortgage-backed securities, resulting in a series of bank failures. Government intervened with massive bailout to stabilize the financial system, preventing a complete collapse but at a considerable cost to taxpayers. The crisis also instigated a credit crunch, making it challenging for businesses and consumers to access credit. This, in turn, hampered economic activity, contributing to a global recession marked by rising unemployment rates and the closure of businesses.
About 9.2% of all U.S. mortgages outstanding were either in foreclosure. By September 2009, this has risen to 14.4%, and between August 2007 and October 2008, about 936 and 439,000 U.S. residences completed the foreclosure. For the next chart is on the stock market fluctuation. The U.S. subprime credit crisis began with massive defaults by the subprime borrowers in mortgage markets. The crisis created a certain degree of impact on financial markets. Additionally, the crisis and the subsequent global financial crisis caused around $7.4 trillion in stock market temporal losses. About $3.4 billion in real estate wealth was wiped out. The next statistics is on the unemployment rate. Many companies went bankrupt, and about 7.5 million Americans lost jobs. The unemployment rate doubled from 5% at the start of the crisis to 10% in 2010. While the economy added jobs after the crisis, many were lower paying and less secure jobs. During the crisis, the net worth of American households declined by about $17 trillion, which is a loss of 26%. The next part is a key players which involved in the subprime crisis. We have here is the banks and institutions, where a number of large financial institutions, especially that were heavily involved in subprime lending. For example, we have here is the Washington Mutual Endemic Bank, also investment banks like Lehman Brothers, and a large insurance company that sold many credit default swaps. On subprimes, like the American International Group (AIG) suffered capital, liquidity, and public confidence problem, and either failed or taken over or were individually bailed out. In this presentation, we have taken an example from the Lehman Brothers during the crisis. This Lehman Brothers is one of the largest investment banks, faced severe losses due to its exposure to subprime mortgage-backed securities, which is known as MBS. In September 2008, Lehman Brothers filed for bankruptcy, marking a pivotal moment in the crisis. Below are the example of the videos that we can find. Besides, we also have the information on the government agencies, such as Federal Reserve and the US Treasury Department. The first one is the Federal Reserve, where known as the central banking system of United States, that have implemented various measures to stabilize the financial system during the crisis. It provided emergency funding and orchestrated the bailout of certain institutions. U.S. Treasury Department, under Secretary Henry Paulson, played a crucial role in coordinating government responses. The Troubled Asset Relief Program, TARP, was introduced to stabilize the financial system by purchasing troubled assets from the financial institution during the crisis.
Next, I will present about the global impact of the subprime effect. First country will be the USA. After that, the USA began with the collapse of the housing market bubble, and it started to fueled by the issues of subprime mortgage and the subsequent failure of many of these mortgages. The next will be the European countries, including the Belgium, France, UK, Netherlands, and Germany. Actually, these countries invested heavily in Americans' mortgage-backed securities, which is a risky subprime mortgage. When this security lost the value due to the defaults and the foreclosure, they may have a face to the losses. The next will be the China. China experienced the indirect effects, which is its export-oriented economy faced the challenges as demand from Western countries, particularly the US and also the Europe, which is declined amid their economics and slowdown. The last country the effect will be Australia. The Australia effect due to its ties to the global financial system. Then the crisis led to a credit crunch and also affecting borrowing costs and availability of credit in the Australian market.
Moving on to the government response. The government had taken several steps intended to alleviate the crisis. Firstly, the government took action by encouraging lenders to restructure mortgages. The government incentivized lenders to adjust payment terms on distressed mortgages and emphasized the importance of refinancing underwater mortgages over pursuing aggressive foreclosure actions. Next, onto a pivotal initiative introduced by Congress, the temporary tax credits for homebuyers. In essence, these tax credits were strategically implemented to stimulate housing demand, thereby alleviating the decline in house prices during the crucial period of 2009 till 2010. Other than that, the expansion of Federal Housing Administration (FHA) mortgage insurance played a substantial role in buttressing mortgage funding. The Congress significantly increased the maximum size of mortgages insured by the FHA, resulting in a notable rise in its market share. Moving on to the Federal Reserve's role, which is the Federal Reserve interest rate policies. By early 2009, the Federal Reserve lowered short-term interest rates to nearly 0%, purchased significant amounts of long-term Treasury bonds and mortgage-backed securities, and committed to sustaining low rates until economic recovery indicators were evident. Finally, stabilization efforts play a crucial role in solving this complex problem. Various housing policy actions, coupled with reduced unsold home inventory, contributed to stabilizing housing markets by 2012. National house prices and home construction began rising, and foreclosure rates declined, indicating a solid recovery in housing activity by middle 2013.
The subprime mortgage crisis of 2007 has lasting impact on the economy and financial systems. Here are some of the long-term consequences. The first one is the economic recessions. The crisis triggered a deep and prolonged recession, with the US economy contracting by 2.5% in 2008 and 3.8% in 2009. This led to widespread job losses, business failures, and a decline in consumer spending. Next is the financial market instability. The crisis caused a loss of confidence in financial markets, leading to increased volatility and credit tightening. This made it more difficult for businesses and individuals to borrow money, which further slowed economic growth. Furthermore, increased government interventions. The government responded to the crisis with a series of interventions include the Troubled Asset Relief Program and the Dodd-Frank Wall Street Reform and Consumer Protection Act. These measures helped to stabilize the financial system but also increased the government role in the economy. Moreover, changes in consumer behavior. The crisis led to a decline in consumer confidence and a more conscious approach to borrowing and spending. This has a lasting impact on the economy as consumers are now more likely to save money and pay down debt. Last but not least, increased regulation of financial market. The Dodd-Frank Act introduced a number of new regulations aimed at preventing future financial crises. These regulations have increased the cost of compliance for financial institutions and made it more difficult for them to take risks.